The institution I represent is African Infrastructure Investment Managers, which is an equity fund manager. It's a joint venture between Macquarie Bank of Australia and Old Mutual Group of Africa. The business has been around for just over a decade. We manage equity, and what that means is we provide the risk capital that goes in at the early stage of the project in the form of sponsor equity or project equity in the context of project finance. Our focus is one of core infrastructure, and that means assets like toll roads, airports, ports, power generation, distribution, really the essence of infrastructure as opposed to maybe the more ancillary infrastructure like accommodation projects and the likes. The framework in which we deploy the money is typically in a PPP regulated environment. The cash also usually sits within a project finance structure, increasingly so. The money that we do manage is sourced from institutions. So the investors in our business, or rather the supporters of our business, not the investors of our business, the supporters of our business are typically institutions, South African institutions and non-South African institutions. We also have strong support from the likes of development finance institutions like African Development Bank, AFC, IFC, and the likes. Currently, we manage just over $1.3 billion, which puts us as one of the leading managers of this type of capital on the continent. And the type of projects that, or rather the size of projects that we seek to invest in, or the size of investments, range between the $50 million to $100 million investments for ourselves. So that translates to something between maybe $200 to $500 million project. I'm going to circle back later on in the discussion, if you don't mind, as to project-specific criteria and considerations out there. The deployment of capital has always been and remains the biggest challenge on the continent. There's no doubt about it. And there are two things that I want to sort of dwell on. One is the role of the sponsor, and the other is direct to answer your question. What would I like to see tomorrow if I could wave a wand? I'd like to see less complexity. Werner's point is that the way we try to do stuff is very complex. And given the information arbitrage and the skill set arbitrage between the public and the private sector, which is far too great at the moment to get the parties across the complexity hurdles, just takes too long. So we need to dumb it down, we need to make it simpler, and we need to really do things far more simply than the way we currently do it. Second point I'd like to see is a better use of advice. There is a plethora of advice on the sell side and government side available to them through transaction advisory services, from donor funders, from the World Bank, from everybody who's throwing lots of advice, but the use of that advice is very poor. And I think if the use of that advice on the sell side could be expedited and could be actually used, that would be a good outcome. I think the evidence of that is, you asked by examples of programs. I think of two programs which have worked well, which have been well structured, and the private and the public sector have pinned their ears back and followed that program aggressively and enthusiastically, with the result that projects come out. One was the South African toll road program 10 years ago, and through the use of the structures and the thinking and the technology that was evolved and deployed on the Maputo Corridor toll road, that was rolled out very swiftly and delivered the N3 and the Bukwena toll road over a period of 2.5 years. And then it sort of went a little off the rails. Another example of good use of program and planning is the current refit program. We had two rounds of the refit. There'll be another one in another 6 months' time. A lot of capital being mobilized, a lot of technology is being mobilized, and a lot of human capital is being deployed in a well-structured program. Again, well-advised, well-structured, and once that program has been set, then expedited. Those are the two things I've tried to do. But while I've got the mic, I just want to switch over, if I may, very quickly to the role of sponsors. Because there is no doubt that I'm pretty sure all of us sitting on the stage here wish we could spend more money and we could spend it quicker. And I've got no doubt that the sponsors sitting on the other side of the bright lights here look at us, and the adjectives that are attached to us are: we're risk averse, we're difficult to deal with, we want to do big ticket items only, etc., etc. what I'd like to put out there is that no project happens in isolation. Every project needs a sponsor. So the sponsors out there are very important to us. We need to find a way whereby we dispel the myth, hopefully, that we're difficult to deal with. We need sponsors to come talk to us, and we need them to talk to the funding market in a slightly different way to that which they're doing. I think there needs to be greater appreciation of the different forms of capital that's available up here. We've got lenders, we've got MES funders, we've got development finance, and we've got pure equity. While we all look at infrastructure, we do so in slightly different ways, and the type of money that we can deploy has a slightly different nuance to it. It's important that you understand that when you go meet the guys, so that you're talking the right language and you're also pitching the product that you're selling to the right form of capital. The other thing is it's got to be simple. It's got to keep it simple. My advice to project sponsors out there is don't think that you have to get a big project to get the attention of the financiers. Keep it simple, dumb it down. If you can fund your project entirely with equity, try do so. If you've got a 100 million project, go and find a source of capital who can do 100 million deals. The other thing is limit the number of parties that you talk to. So often we see guys who have already spoken to 50 people, and when they pitch up for a roadshow, they've already got 14 funders in tow who all want a slug of the deal. The manner in which these deals are done, because it all anticipates future events, is you only get financial close when you all get consensus about what the future holds. And it's a lot easier to get that consensus if you're talking to 2 people than if you're talking to 20. We've got a long way to go. To contextualize where infrastructure sits in the greater scheme of things, one needs to take a step back and look at economies and stable long-term economies. And broadly it's recognized that economies that have a high savings base is what government should be seeking to do. They should be creating environments where Joe Average and Joe Public is saving his money for the future, which builds robustness into the economy. To do that, he needs to create something, or the environment needs to have something which is worth saving for. So the first step is you've got to create long-term saving. Second is you've got to create title. So the title that you have on your property, the title you have in your house, in your car, on your boat, and the framework that was being spoken about earlier. All this framework does, the legislative framework, is it gives a form of title to warrant saving for. So you've got to have that. Then once you've got that, you then got to get people to start saving. And that saving manifests in pension funds. So currently we have really in Africa 2 big pools of pension capital. We have South Africa at 270 billion odd. We have Nigeria at 15 billion odd. And then we have some smaller entities like Ghana, Mozambique, not Mozambique, Kenya. But they are really very, very small. So in the great context of things, Nigeria as the second biggest one after South Africa's 270 plays 15. So you can see how that evolution is going. And thirdly, finally, we need to get the final stage, which is reaping the rewards. And in these projects, they're long-term. The investments are made long-term. The longest concession we have in Africa is the Maputo corridor at 13 years, 14 years of a 30-year concession. And all the rest are still, they're not even teenagers. So in that cycle, which needs to be completed to make infrastructure an asset class, like it is in more developed countries like Australia, who've been doing this for the last 30, 40 odd years, we've still got a long way to go. But having said that, where this continent does benefit from it is the recognition of the necessity is absolutely apparent. Other jurisdictions, it was an asset class which sort of emerged discretionarily. It was interesting from a funding perspective, money flowed in that direction, and it emerged on the fringes of core economy. The opposite is true here. Every politician, every guy out there, every financier knows that the salvation of, not quite salvation, but certainly a core component to the salvation of Africa is the state of its infrastructure. And everyone knows that the public coffers of Africa can't satisfy the need. So we'll get there faster than other jurisdictions. The Lekki Concession Company And I would classify it as success because it reflects a lot of the components that we've been speaking about during this panel, as well as questions off the floor, in that it reflects local content, it reflects a high level of local debt, it reflects a very strong commitment from the host environment, the Lagos State Government, and the manifestation of my founding philosophy of trying to broaden the economy, getting private capital at play, creating title for people to invest, all this type of thing which creates product for enabling their own pensions environment. It reflects the type of thing that Jonathan was talking about, which is that political risk. It does dissipate over the period of a project. Once a core infrastructure project is in place and it's delivering benefit to the community, it's a lot less politically exposed than earlier projects, and this project reflects that. And it also reflects a state of dynamic flux, which the project has to have. I think Werner was referring earlier to the fact that we spend a lot of time trying to create the future when we reach financial close, but very rarely does the future actually behave itself, and usually the project has to ebb and flow to accommodate the realities of the future. Now, this particular project reached financial close. We saw it for the first time in 2006, 2005, 2006. It reached financial close in 2008, just at the time, right after Polokwane. We just had 16 ministers resign in South Africa. The rand had disconnected materially from everything. At that stage, rand was trading at 12.5 to the dollar, and the naira was just still flatlining. So, very expensive project from a rand's perspective, but it went ahead nevertheless. It reached close within that state of flux, with the strong support from the likes of RMB, Standard Bank, ourselves, notwithstanding the winds of change which were afoot. 70% of the project financing comes from local lenders, massive support, and what that has enabled is a vested interest in this project with local capital. It's also created a platform for local lenders to actually look at a real live project, understand the mechanics of the documents, understand the nuances of cash flow financing. And it's also occurred at a time when elections have been going on. So elections occurred in Nigeria last April, I think that's right, during which stage there is an enormous amount of flux in Nigeria, very political environment, and trying to introduce something like user pays. If you think e-tolling is a big debate, you should have seen what happened in Lagos. And what happened was the project was flexed. The introduction of tolling was delayed. There was a repeat of the public consultation process to engage with the community down the road as to what this project is about, why it's necessary, etc., etc. The project was implemented in a different phased way in partnership with the private sector and the state. The state supported the project during this phased implementation. And currently we sit with a project which is working. It is collecting tolls. The user pays philosophy is being endorsed by 85,000 motorists per day. And there is no real debate as to whether this project is a success or not. It looks different. For those of you who fly out of Lagos, do yourself a favor, look out of the window as you leave in the evening, and the one continuous stretch of street lighting that you'll see is the toll road. It's fantastic. And it's a four-lane highway. It has reduced traffic times from 4.5 hours to 45 minutes, and that's all good stuff. Having said that, it's not all champagne and Skittles at the moment, because it's still going through a restructuring. Some of the plazas are moving, some of the tariffs need to be readdressed, and that's not abnormal. What is slightly abnormal is maybe the scale of the restructuring, but it again underpins my very first point, was the support which was given by the Lagos State Governor and the government to this project at the outset is what is at the heart of these renegotiations. The vested interests are such that the parties are sitting around the table, they're saying, we thought it would look like that, it does actually look like this, and this is what the future is going to look like, and how do we morph this project to enable it to deliver on its fundamental dividend, which was to deliver services to the community. We've still got a lot of work to do on it, and we're working with a lot of people, including AFC and, well, a lot of people in the room here. And it will remain work in progress. Of that I've got no doubt for another period of time. But I think that active dialogue and the morphing of all those criteria that I've just alluded to do make that project, in the context of African PPP, an absolute success.
Doing business in Africa, you can't afford to be without Africa Investor.